guys know what time it is. And in case you don't, welcome to another exciting episode of the Extraordinary Men Podcast. You guys should know me by now. And if you don't, let me remind you. My name is Phil Jones, Mike Jones, to those who know me personally and professionally, and I am the host of the Extraordinary Men Podcast. You guys know this absolutely insatiable, delectable individual on the other side of me who is always there. He is never not there. He is like the most God, I don't even want to use them words because them words make you sound more like a sidekick than the man. This is the man right here. It's like if I wasn't here, it wouldn't even matter because he here. That's how dope he is. State your name, man.
What is going on, y'all? And when you say extraordinary men, you got to put the D in front. That's why it's
B,
big like that. You know what I'm saying? That's
B.
why it's big like
Extraordinary
that.
man.
It is, I am Midas. Make sure you put a king in front of that. Let's go.
All right. So, last episode, we decided to talk about credit, but not just credit. We went ahead and we started breaking down some of the basics when it comes down to helping people understand the very bare minimum of the breakdown of credit, the scoring systems, from the poor to fair, good, and excellent credit, and understanding how the credit calculations come into play, urging people pay your bills on time.
Oh,
But
yeah.
even more so than that, just getting the introductory talking about, because as we know, to be extraordinary, you got to do extraordinary things. And there's nothing more extraordinary than having your name hold value, especially when it comes down to purchasing or financing your life in any regard. So let them know what we're going to talk about today on part two.
Okay, so today what we're gonna break down is now the last one again, like you said, we broke down the different percentages of what each category was, and that was for FICO. What we're gonna do is we're gonna explain the difference between FICO and Vantage. I'm also gonna break down the different percentages of Vantage, and then I'm also gonna break down the other types of categories that's within FICO. So this is one that you really want to take notes. It is a little uh very, very educational, this one, but we're definitely not going to try to bombard you with a bunch of different terminology, nothing like that. But you do want to take notes.
All right. So basically, you have multiple credit scoring models.
Mhm.
And what you have to understand is that when you're looking at certain things, you're trying to get a gauge of where you are or what the people will be looking for to know what you're trying to get. Like, for instance, if you're in the market to buy a new house, new car, whatever, and you know that there's certain score ratings that you need to get in order to qualify for the type of loan that you want or whatever the situation may be, you have to be educated on, number one, the tools to get what it is that you want to get, what credit bureaus are being looked at most commonly to find out what it is that you need. And then number three, how to get your score where you need it to be so that you can qualify and get in the door. So first things first that I would say is that there's some very basic stuff that you want to know. Like, for instance, if I'm applying for credit cards, every credit card does not use the same credit bureau. For instance, you might look at a Capital One card. Capital One will lean a little bit more into Equifax and Experian together before they make a credit decision. Whereas if you go into like an Apple Card is leaning into your TransUnion. You go and you're applying for a car loans tend to look into your TransUnion. But when you're going to go buy a house, they have a completely different scoring model. And they'll take the average of the three scores to where they'll look at your middle score and say, okay, that's what we're going to judge you off of.
Yep.
Now, there's a little bit more complexity in that, which Midas is going to get a little bit deeper into. But that's why I wanted to open up to pretty much have a conversation saying that it's more than just being educated about the basics of your credit. You have to understand what credit is being looked at. And you have to understand how to look deeper to find the specifics that you want to find out about what the qualifiers are for that thing that you're trying to do. You want to take it from
Yeah.
here?
So to add a little bit more sauce to the ribs, you mentioned the Apple Card, and that's a really great card that you brought up. Now, for those of you that don't know, the Apple Card is actually uh, backed by Goldman Sachs, the Goldman Sachs Bank. Okay, and like Mike said, they use TransUnion. So if when you're applying for these cards, you want to find out who is the actual issuer of the card. Okay. If you're applying for a Walmart card, Walmart themselves is not the issuer of the card. You want to find out what bank they're using to issue their Walmart branded card. And then you want to find out what credit bureaus that those card issuers are using. So that's just one way to find out, how to keep track of finding out, which bureau is which. All right. So what I want to talk about first is the differences between your FICO and your Vantage. There isn't really big much differences between them. It's just that your FICO uses a 45-day span, so it's going to keep track of all of your payments and everything that you do with your credit within a 45-day span. Every 45 days it starts over versus where Vantage is every 14 days. Okay. FICO is usually more for like mortgages, vehicles, student loans, stuff like that. Okay. Vantage is more bank cards, credit cards. Yeah, more like, yeah, bank cards and credit cards. All right. So, and there's this one question that I seen circulating around, and I guess people are trying to, I guess, figure out or find out how can you flip a Vantage score into a FICO score and vice versa. I don't think you can. There's no official way to do that. You can't do that. I've never heard of anybody having the ability to do anything like that. So, as far as I know, it don't exist. So that's not to say that it won't in the future, but as of right now, it don't exist. So, all right, let's get into it. So the first thing that I want to break down, or the next thing that I want to break down, is I want to talk about how we talked about the 35, 30, 15, 10, 10. Okay. Those are your category breakdowns for FICO, your payment history, your length of time, your credit mix, and things like that. Your Vantage also has the exact same scoring model as well. It's a little bit different, but it's all the same. Okay. So payment history for Vantage, make sure you're taking notes. Payment history for Vantage is actually 40%. Okay. Credit history or credit length, that's going to be 21%. Your utilization is 20%. Your overall balances is 11%. Your most recent credit, or how often you apply, that's 5%. And then your overall available credit is 3%. So basically the same categories, but they score it differently. Okay. Next, what I want to talk about, and I'm leaning more towards FICO because that's what's used the most. A lot of lenders, you do have a lot of lenders that still use Vantage, but not as much. Everything is kind of more on the FICO side now. So, what a lot of people don't know is you actually have different types of FICOs. You don't have just one FICO score. Okay. Make sure you're writing this down again. Okay. You have a FICO 2, you have a FICO 4, and you have a FICO 5. Those are mainly used for your mortgages. Okay. You have a FICO 8 and you have a FICO 9. Okay. These are pretty much just your widely used overall score. It's basically FICO 8 and FICO 9 is just a blanket score. Okay. That's more like your threes and stuff like that. Now, what we have coming out now, or it's out now, but it's not widely used just yet, but some places are using it. You have a FICO 10 and a FICO 10T. This is going to be for automobile and bank cards. So as at right now, you may see like FICO bank card or FICO auto. You could look at that as FICO 10. Okay. So I want to break that down to you guys so that you know what it is that you're looking at. Okay. Both models, as far as the range, your score range is still the same, 300 to 850, both FICO and Vantage is both the same. Now, Vantage, though, may look at fair different versus how FICO looks at fair. So fair on FICO may be between this range of 600 and this range of 600, where fair on Vantage may be as low as 590 to some range of 600. You know, those scales may be different. So you want to take a look at that as well. That's pretty
Like
much man capture.
I actually have a scale right here to show you the breakdown for Vantage versus FICO as far as how the fair, poor, excellent is breakdown. Can I bring it up?
Absolutely, yeah.
All right, so this was coming from an article written in Forbes magazine. And if anybody wants the article, I can make sure that it's available. It'll be in the credits of the video. But this is the breakdown here as far as what the differences are between the credit scoring models. So, for instance, poor, very poor, fair across the board to 669 here, where it's up to 600. Good is like a 601 to 660 in the Vantage range, but 670 to 739 in the FICO range. 740 to 790 is considered very good. 661 to 780, you see that's a huge leap.
Mm.
Then exceptional and excellent, 8 to 850, and 781 to 850. So needless to say, no matter what the metric is, you're trying to shoot toward the 700. So I mean, to the high 700s, 800 range. That's what we're going for.
And then another misconception that I want to clear up is that a lot of people think that just because they have a high credit score that they're going to qualify for anything and everything under the sun, and it don't work that way. You have to have a healthy credit report in order to be able to qualify for the things that you want to qualify for. So yeah, you know, you may have a couple good on time payments, you may got a couple credit cards, but if you don't have a nice healthy built out credit report, if you don't have at least, I say at least for me, what I have, I got about maybe 15 credit cards. I got about maybe three loans. I got about two car notes. You know what I'm saying? All on time. So you want to make sure that you have a healthy credit report so people can see that you can handle all these different financial products. That makes them comfortable, you know, opening the door for you and saying, okay, you handled these, okay, and not only do you have these different credit lines, but are they high limit? They look at that too. Just because you got all this, well, what's the limit on them? Okay, this card is 3, that's good. This card is 5, that's good. Okay, this card over here, okay, your loan is okay, you got a $50,000 loan, okay, that's good. Okay, but if you looking at, okay, the max you can get is $500 on the card, you can't try to shoot for a $10,000 card. That's not going to happen, you know. So I just want to make sure that you guys understand that having a 750, that's just not, you could just walk in and just, I got a 750, give me that card. That's not how that works.
Now, what it does do is it basically buys you a better seat at the table. So
It
if
de-
I'm sitting here, and generally when lenders are giving out loans, you have a score, a minimum score to qualify. And then once you get past the qualification range, then you have the where they determine interest rates based on where you stand. So the better the score, the better the interest rate. So when you're going to go get a home loan, you're what they call a preferred lender. Because the thing is that your credit score is an indication to lenders on the likelihood of you paying the money back.
yeah.
So you don't get punished for showing an exemplary situation where you have shown that you can pay all your money. That hey, not only can I pay the money, but I pay big sums of money. So when you look at these situations, like for instance, like what's that? With charge cards, for instance, right? The one thing about like the Amex charge card that I learned over time is that it furnishes a behind closed doors limit. So even though it says it's unlimited, it's not really unlimited. What it is that it furnishes the card based off your ability to pay. So if you're using the card frequently, and then using the card frequently is like you seem to average at about $2,000 in spending, that's what the card believes that you can pay. So when you try to go 2,500, it's not going to let you because you're showing them activity that says that you might not be able to handle anything beyond 2,000. So in order for you to furnish your limit higher, you have to use the card to completion, completely pay it off. Use it again. You have to pay it off multiple times throughout the month. So it's saying, oh, this guy's spending $5,000 on the card. We can furnish his card up to $5,000. Oh, he's spending $10,000 on the card. So after 3 months, 4 months of you spending consistently 10,000 or more, they'll start to furnish that limit based off what you've shown them that you can pay.
Mm.
So a lot of the times we have to understand too that when you, oh, Midas, I want you to talk about this. Credit cards. So when you talk about the type of credit cards that people apply for, like when you, let's say like the Capital One, like the Saver One versus the Capital One Saver, the Quicksilver One versus the Quicksilver.
Mhm.
So those cards that give you those little tiny limits versus the higher tier card that give you the bigger limits. Talk about those.
So the smaller limit cards are basically kind of like your intro cards to try to get your feet wet, and that's the company's way of, saying, introducing you into the ecosystem. They're going to start you off with a small limit. Over time they'll slowly start to increase, but you, again, like I said in the last one, you got to use the card so they can see that you're actively, using the card, utilizing the card, and trying to be a great, show them that you're a good customer. And then over time they will gradually increase. Now, secret, there is one secret to getting automatic increases, is that every month I go in, and even though my pay may be the same, or even if I make $1 extra, I always go in and then I redo my annual income. I reset my annual income, and that tells them that, hey, what I'm saying, I'm making good money over here. Knock knock, I'm making good money. Send me a credit increase. Send me a credit increase. You want to be mindful on these higher limit cards. You want to be mindful with the they try to get you in, or they do get you in on, hey, spend, you know X amount, and then you can get 30,000, 75,000, 100,000 points after you spend X amount of money on the card, things of that nature. Now, if you want to start getting into that game, you want to make sure that you have the adequate amount of money to be able to play that credit card game like that, because you want to pay those off in full. You want to try your best not to carry a balance. If you do carry a balance, it's okay, but you don't want to carry a 30% balance. Try to get it down to where it's under that 30%, and then you can carry that balance if you so choose to. But I try my best to try to pay mine all off by uh, the statement date. So,
Now, now
what
one,
what specific information did you want to know?
well, one of the things that I wanted to touch on that I was hoping that you were going to get to, but I'll go ahead and I'll sauce them ribs up. You can get caught into a trap by applying for low tier cards because when you want to apply for higher tier cards, they're going to look and see, oh, we got two or three low tier cards with 500, $600 limits. We don't know if he can handle a $5,000 card.
Yeah, I go there. So you got companies that honestly will just all out reject you, period, just based off the type of card that you have on your profile. So if you got like a credit, what is it, credit one, like those real subprime cards. I can't even think of the name of them. I don't even deal with them. But yeah, so credit one, those type of cards that's in that range, you got a lot of companies, a Capital One, a Amex, these higher tier cars, these X1s. you're just automatically just gonna get denied simply because they see that card on your profile. Period. You can have a fantastic payment history, everything, but because you got that subprime card, you will get denied. So yeah, you really want to be careful the type. Now it's cool if you in a credit building phase where you pretty much scraping the barrel and you trying to claw and climb your credit score back to a decent score. Use the card for what you need to use that card for. Get rid of that card. I'll be honest with you. Get rid of that card. Your score is going to drop when you get rid of it. But if you establish other more prime credit, then when you get rid of that card, it shouldn't be that big of an effect on your score.
Now, obviously, results may vary. We're just going off of the experiences that we have personally experienced with some of these things that we've had to actually build ourselves out of. And it's like, I'm pretty transparent with it. It's like, oh, my credit was terrible for a long time.
Me
And
too.
my identity got stolen, first and foremost. And then it was part of my own irresponsibility. So when it
Mhm.
came down to going through the process of repairing my credit, getting on the phone, negotiating with creditors, understanding that the having conversations with uh, the collections agencies, like there really was no reason to be talking to them. I would tell people firsthand, First Premier credit card was one of the worst decisions I ever made. It was terrible. It was
Mhm.
terrible. It was an extremely terrible experience, and I regretted it after the fact. But at the same time, it was more so because of the fact that when you're dealing with subprime lenders, they can pretty much do what they want because they know you don't have very many options. So they can charge you ridiculous interest rates. And then again, it's like if you're already at the bottom of the barrel, you should not be holding balances. So I'm gonna say that part too is that if you are playing the credit card game in any respect, you shouldn't be holding balances on cards. Interest rates don't matter if you're paying in full.
Yeah, that's a big one. Yeah. A lot of people always, oh, that card is 24% and blah, blah, blah. Okay. Well, if you pay it off, it doesn't matter. You never get hit with the 24%.
Yeah, 24% of zero is zero every time. But at the same time, it's like for those who are playing the credit card game in their respect. And again, we say credit card game, we're not talking about scamming, we're not talking about getting over, we're not talking
No,
about anything illegal. Just want to make sure that we're keeping out there because there's a lot of charlatans that want to make things sound better than what they are. And when he was referring to his income earlier, I just want to make sure I touch back on that part. Is money he actually earns. It's not based off of, hey, I'm just going to create some fictitious amount because he gets his money different. He doesn't have a fixed income like somebody else to where you're waiting every 6 months to a year for a raise review. If this month he know his average per year because of how he earns his money, he lands a new contract and that new contract is $60,000 is going to change the average of what his annual is.
Mhm.
So you have to understand that it's a very specific thing depending on how you earn your money is how you should list your annual income. We're not condoning lying or scamming, trying to get furnished credit card limits. And whether that credit card company will or won't do the proper due diligence to check and see your ability to handle such a large credit card, time will tell. Time will tell.
you know, and they say, with great knowledge comes great responsibility, stuff like that. With great amounts of credit comes great responsibility, and you really need to be disciplined for sure if you're able to gain these large amounts of credit, and you have to have a plan in place to be able to utilize these credit to their full potential so that you can maximize these lines of credit and produce income for yourself. But if you just got it just because you have it and you just finna splurge it and blow it and all that, there's no plan behind it. I don't recommend it for nobody. There's no reason for you to be going after these lines and sitting on these lines, and there's no plan behind it at all. Um, Another thing that I want to add some more sauce on the subprime cards. Some of these companies make it extremely difficult to actually remove that card off your credit, and they're gonna play that game with you. So you may have to send multiple phone calls. You may have to start sending letters. You may have to start contacting the CFPB and all of that. So that's why I just say, man, just stay away from subprime companies altogether if you can. If you absolutely have to use them, utilize it, saying, to the maximum of its potential so that you can build your credit and try your best to get out of it as
I would
fast as possible.
I would also say that if possible, try a secured option before you go subprime.
That's great. Yeah, those are great options too. And going secured is a great way to give yourself a big line of credit. So at the minimum that you could put on a card, is
Two or
300.
300,
Yeah,
depending
it's
on
like
the bank.
300 bucks. Yeah, depending on the bank, it's like 300 bucks. And you could start with that on your own secured card. And then you can also go back and add more money to your own card, and you basically increasing your own limit. Now you want to be careful with that because the bank may rerun your credit to add that extra money to your card. So if you're going to do it, make it worth it.
Yeah, like at the end of the day, it's like I would always make the suggestion, and when I talk to people about the journey that I had to go through just to repair my credit, I try to explain to them that you have to understand that it's easier to just do it right the first time than it is to repair it and fix it.
Yeah.
Because every little thing that you do, it will catch you. It will catch up with you. It will be a reminder somewhere. Every little blemish that you have, didn't pay that medical bill, is going to be that. It's going to be like a black eye every time that somebody sees it. Oh, you missed that payment and you let it go into 30 days negative, it's going to be that. Doesn't matter if you got 2 years of solid payment history after that one red flag. Doesn't matter. That ding is going to be right there. You want to avoid that at all costs because when you're trying to move up the ladder, it's like these are things that people are going to look at. Well, I see you missed the payment back in 2017. Yeah, but I've had a stellar payment history ever since then. Yeah, but the person over here has had a stellar payment history since 2004, since they were able to apply for credit. So if I had to compare apples to oranges, you don't necessarily make the grade. And also another thing too, before we go too far off of some jobs, some employers, your credit history plays a part in your ability to get some jobs,
Oh
whether
yeah.
you know that or not.
Hmm.
I don't know if people actually understand this, but your credit history says more about you than just your ability to do credit or your ability to pay your bills on time. What it also says about you is, are you responsible? Do you get things done on time? Because if you don't pay bills on time, which is something that you actually use on a regular basis, what makes me think you're going to turn in my reports on time? What makes me think that you're going to show up to work on time? If you skip payments, then what makes me think that you're not going to skip work?
Yeah.
So there are other underlying factors that do contribute to the reason why keeping a stellar credit history is so necessary.
Yeah, if I'm not mistaken, I believe like Brinks or Garda is one of them companies that take your credit score into consideration, because if you got bad credit, chances are you got money issues. Well, that's our business. Like, we specifically deal in money, delivering money to stores, delivering money and picking up money out of ATM machines and stuff like that. You got money issues. Who's to say that, some money won't come up missing out of these bags? So that's how they look at that, man. So you want to make sure, again, like you said, that your credit score or your credit history is stellar.
Now, for the sake of where we were going today, one thing that we absolutely want you guys to understand, at least this is from my point of view, one of the most important things to understand in credit scoring models, understanding what you're looking at. You need to be able to research, and I will always make a suggestion like my FICO. will be the perfect tool. Yes, it's going to cost you money, but you get a chance to not only see all three of your scores lined up next to each other, but it'll also give you your auto scores. It'll also give you your housing scores. It'll also give you a breakdown to tell you that, oh, you need to improve this much to qualify for a loan. You need to improve because the average of people who are qualifying, I don't care what anybody tells you, oh, you can get a loan with a 580. Yes, you can. But those loans that they're going to offer you for a 580, you might not be able to afford them. There's other nuances to those things. Oh, we can get an FHA. Well, guess what? Your dream home may not be FHA eligible. So you have to be mindful of just making sure that your credit score is where it needs to be so that you don't have to worry about these things. So if you use the tools in my FICO, it's giving you actual scores that when they run your credit for the mortgage lending companies, that's what they're going to see. So give or take, depending on when the last time the score was ran, is going to give you an average. So most lenders are going to tell you, okay, we're looking for an average score of a 620, 640, preferably, at minimum for you to qualify for a decent loan. Then on top of that, calculating income and debt and other factors to be able to determine, hey, this is how much we can approve you for. So you want to be mindful of a couple of these things always when it comes down to your tools. Now, when it comes down to your Vantage scoring models, I don't know very many, and you might look at like something like Credit Karma, where they give you your Vantage scores and they'll talk about different lenders and stuff. But I have tried that and I've went through those models. And once you go through those companies through the gateway, they're looking at your FICO scores. Your
Yep.
Vantage scores is a roundabout of where you are, but it's not what majority of lenders are using.
It's still great to use it though to look at what you actually have on your report, what's reporting. You can see what's being reported, and that's a great tool to have. But as far as like relying on it for your score, yeah, like Mike said, man, they're mainly looking at your FICO. Um, Another thing that I want to talk about FICO is that sometimes it can take almost a half a year for things to report for FICO. So just keep that in mind. Sometimes stuff reports right away, but I've had instances where it actually took up to like 6 months for something to pop up. So just want to put that disclaimer out there as well, so you guys are like, man, where's this? I did this specifically for this to pop up, but you gotta give it some time.
So even with that, like what he's saying, make sure you're planning things out. That's
Mhm.
why I would make a suggestion that if you don't have a financial advisor, get one. If you're more on the independent side, use tools like MyFICO because they'll give you the breakdown in the program to allow you. And no, MyFICO is not a paid sponsorship. It's just that it's a tool that I use religiously
Mhm.
because of what it's able to do.
Yep.
So it'll give you in there the roundabout to let you know if you pay off this much debt over this much period of time, if you pay off this much on a monthly basis, on a regular basis, that this is what your score potential can be. And you use those tools to get a gauge of roundabout where you're going to be because it's going to say if your credit report ages this much, if you pay on time over said period of time this much, with this much on time payment, with this much amount of chipping away at your average total debt, that this is what the potential of you being in 3 months, 6 months, 2 years from now. So again, it's like as he was saying, when you're trying to gauge, you're gauging long term. It's not a okay, well, I got a lump sum of cash, I pay it off, and by next month I expect to have A1 credit. It doesn't work that way. Doesn't work that way. You gotta give it time for it to reach full fruition for what it's gonna do. So sometimes it's gonna take anywhere from 90 days to 6 months for you to see the maximum of what it can do for you. And then it also takes for you to rebuild a different reputation with those companies and for the FICO to see it. So if I was maxed out before I got hold to that loan, that lump sum, but then I show 6 months of keeping my credit utilization between 15 and 30% or lower, then now I'm creating a new reputation, not only with the credit card companies, but the way that the scoring models are seeing it is, okay, he's learning his lesson.
Hmm.
He's following the steps. His score is now jumping because he's following the steps. He's keeping his utilization down. He's paying everything on time. Now you'll see the fruit of the labor that you had.
Yeah, your credit report is your paper trail of you. And when people run your credit, for you to do, the different type of things that you're trying to, accomplish, they can literally see your progress like in real time. They can see it. So that's why it's very imperative that you keep it squeaky clean.
And remember, it's basically telling a story about you. It's
Yeah.
telling a story that you can't tell. So you can say what you want to say about who you are, or who you think that you are, or who you want people to see, but your credit score tells me everything I need to know about you. If it says pays on time, pays as agreed, okay, well, paid as agreed means man of his word.
Mm-hmm.
Trustworthy
Yep.
means you can handle things. The more debt that you can handle, the more trustworthy you are with bigger things.
Right.
So you're less likely to run off with the bag because you're not, clearly not tempted with it. Because if you were tempted with it, then you go run up this $10,000 card and then just be frivolous and foolish with it. But clearly, you're working within your means, so I can sit you in front of patient to ensure that you won't do something irresponsible with the money. The likelihood.
Yeah. And then to add some more sauce in them ribs, you had mentioned uh collections. And one of them that you mentioned was medical. Now, uh, again, not advice or anything like that, but I would recommend that you read HIPAA and that you read your consumer laws. If you seeing medical stuff pop up on your credit report, I won't, what I'm saying, divulge any more information than that because I don't want nobody to hang on to my words and put it out there as law. But I'll just say read the HIPAA and read your consumer laws if you're seeing medical on your report. That's all I'll say.
So I'm gonna just show this real quick, and then after that, we can go ahead and move on to the next piece. But it
Mhm.
was just a brief piece that Consumer Credit had posted about the removal of credit card debt. I mean, not credit card debt, but of medical bills. So it
See,
says,
see what I said?
so hold on, consumerfinance.gov. This is from the data research section. I'll just go ahead and read off to this top piece. Again, do your own research. This was posted just in April 26th of this year. Consumer credit and removal of medical collections from credit reports. Says that three nationwide consumer reporting companies announced the removal of medical collections under 500 from consumer credit reports on April 11, 2023. So we estimate that the reporting change removed at least one medical collection from the credit reports of 22.8 million people and removed all medical collections from the credit reports of approximately 15.6 million people. That's huge.
Gotta,
And it's
but you
probably,
gotta, but you gotta look into why they did that.
and
That's why I
that's
said
why, and that's
HIPAA.
the homework that I would give to you guys who are watching, to take the time to actually look into the reason why this happened, to gain an understanding on what's going on behind the closed doors, what's going on behind the scenes, and why are they stepping in to do this with medical debt, and then what's to come. Because you have to also remember that the president at one point in time was saying something about doing credit reform
Mhm.
for what it's like they're trying to get rid of the FICO scoring model. So we'll see where that's going. And then on top of it, too, you got to remember that they're also trying to do this new thing with housing to where it's kind of like those people with good credit kind of are getting the brunt end of the stick to level the playing field for people with less than perfect credit. So that's a
Yeah,
whole nother.
yeah, they're trying to add like an additional small percentage. I mean, at the end of the day, it works out to about, I don't know, like an extra $40 a month on your mortgage if you're in a specific tax bracket. I mean,
Mm, I
I
mean,
think
it's
it's
like it sounds simple, but
there.
then when you do the math, it's like 40. Let's just run with that $40
I
times
think I think
12
it's like an
months.
extra $40, I think.
All right, like we're gonna run with it. It's for
I'll pull
40.
the law back up, or I'll pull the, I guess, the docket back up.
Well, here's the thing: $40 times 12 months,
Hmm.
$480. The average 30-year loan is saying that I'm getting hit with almost 15,000 additional
Yeah, I
dollars
think
on
it
my
was
loan.
around there, 15,000 additional dollars. Yep.
Yeah, so it's like to somebody that might be chump change, but to me, it's like I shouldn't have to pay an additional anything because I did the right thing. So you want to charge me another $15,000 for my dream
Win
home
some,
because
you
I
lose
did it
some.
right?
I
So
mean,
again,
but at the end of the day, I mean, you're supposed to be passing that payment on to the renter anyway.
but
You know
I
what I'm
mean,
saying? Again, who cares if the credit card percentage is 24%? Just pay it off. It's the
okay.
same thing. Once you put the renter in there, it's paid off.
Yeah, that's if you are in the business of renting your property out. If this is your one and only home, and that's all you're
I
doing,
don't, and this is only just my own personal belief. There's zero reason for you to own a crib if you don't have no plans on renting it out. That makes no sense to me. That's
that's
just me. That makes no sense to me.
yeah,
No sense.
you know what? I mean, it makes perfect sense in a sense, but we'll get into that in another episode. So, thank you guys for tuning in. As always, hopefully you learned something with us today, and as always, comment, like, share, subscribe. Make sure you let us know everything that you guys took from what we said today, and make sure that you guys compliment how amazing that man looks with that extraordinary man attire on.
But man, make sure that y'all get y'all stuff, man. We got it for sale. Just hit us up on the Facebook group. Let us know if you want to get your hat, if you want to get your shirts. And then I want to explain to y'all that the letters on this shirt, they're not flat. It's not like a pressed on, ironed on. No, the letters are literally raised up off the shirt, but they're protruding out of the shirt. And the quality is amazing. And the same with the hat. It's not just like a flat stitching. They're literally raised off the hat. So good quality, y'all. It's great quality. You know what I'm saying? Our boy Kadeem, man, he really, made sure that the quality and that we were putting our best foot forward so that when you guys receive these products, you can be proud of these products. We're proud to present these products to you. So man, please grab your hats, grab your shirts, grab your hoodies, grab your long sleeves. We got them. Grab your polos. If you go back and look at the other videos, you'll see that I was in the polo joint. We got white and we got black. I mean, we can probably get it in whatever other color you want. Just send a request.
With that much being said, thank you guys for tuning in to another episode of the Extraordinary Man Podcast. And I'm your host, Phil Jones. Mike Jones, have you guys know me personally and professionally. And you guys should know the co-hostess with the mostest, the most extraordinariest of all the extraordinariness, the king of all kings, the mostest of the hostess. State your name.
I am Midas. Make sure you put a king in front of that. Let's go.
Peace.